Good morning. Welcome to Medalist Diversified REIT fourth quarter and fiscal year 2019 earnings call and update. On March 4th, the company issued a press release that provided an overview of its results. Today's conference is being recorded and will be available online. All participants on this call will be in a listen-only mode. The call will be followed by a question-and-answer session. Before the call begins, we would like to remind everyone that various remarks about future expectations, plans, and prospects constitute forward-looking statements for purposes of safe harbor provisions under the Private Securities Litigation Reform Act of 1995. Medalist cautions that these forward-looking statements are subject to risks and uncertainties that may cause actual results to differ materially from those indicated, including risks described in the company's filing with the SEC. Any forward-looking statements made on this conference call speak only as of today's date, Monday, March 9th, 2020, and Medalist does not intend to update any of these forward-looking statements to reflect events or circumstances that would occur after today's date. With that, I would like to turn the call over to Chairman and CEO, Tim Messier. Please go ahead.
Hey, good morning, everyone, and thanks for getting on the call. As Mark said, this is an earnings call. However, I will start by listing some of the great fundamentals of our company at this time. In the fourth quarter, we doubled the size of the company with three great assets: a shopping center, a very attractive hotel in Clemson, South Carolina, and a flex property in Greenville, South Carolina. This adds to our already attractive portfolio of three other properties. So in the fourth quarter, we had six properties creating earnings and revenues for us. And with that, I'd like to turn it over to Brent Wynn to talk about our earnings, and then we'll ask any questions regarding that as we move along. I will say that you have access to me after this call. You may call me on 804-344-4435. Brent?
Good morning. As Tim mentioned, I'd like to start off with some major kind of bigger picture items. During the fourth quarter of 2019, our portfolio size doubled from 3 to 6 properties, which increased our assets by $30 million over December 31st, 2018 assets. During the fourth quarter, our revenues increased 66.8% over the fourth quarter of 2018 from to $3.1 million, and that was due to the three acquisitions that closed, and which we had the benefit of all three properties during the fourth quarter. During the fourth quarter, we also saw a decrease in non-recurring expenses, primarily non-cash share-based compensation items, and a loss on impairment. Our net loss for the quarter was $734,000 compared to $1.5 million for the quarter ended December 31st, 2018. As a REIT, we have very heavy non-cash depreciation and amortization items, so we will be talking primarily going forward about net losses, but when adjusted for those non-cash items, we will start to see stronger cash flow going forward. This leads into AFFO, which is a supplemental financial measure that we use. During the fourth quarter ended December 31st, 2019, our AFFO increased by $823,000 to $380,000 over the fourth quarter of 2018. This is 8 cents per common share. For the full year, our net loss was $3.8 million compared to $2.9 million for the prior year. Again, this is a function of non-recurring expenses and heavy depreciation and amortization costs. Looking at our AFFO and FFO, as I said, our AFFO increased significantly, but our funds from operations also increased substantially from $769,000 negative in 2018 fourth quarter to $287,000 positive in the fourth quarter 2019, over $1 million increase.
So going forward, we plan to add 1 to 2 properties in the near term, which will create more cash flow and be accretive to the REIT. We do not have a prediction on when they will close, but we expect them to close in the first half of the year. Don't know. We don't have a closing date yet. Our plans for the future are to grow significantly, buying properties in the Southeast where cap rates are 7 to 9%, much higher yields than in primary cities, in the secondary and tertiary markets of the Southeast. With that, I will open it up for questions regarding our earnings.
Thank you. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. And for participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Our first question is from Ben Zucker with Allegiance Capital. Please proceed.
Good morning, guys. Thanks for taking my questions, and congratulations on what I view as a pretty strong quarter and definitely a nice turnaround and jump in the business and the underlying metrics. I guess just to kind of kick off, you guys now own 2 hotels. Could you talk about maybe the seasonality factors and how that might have played into both the fourth quarter results, but then also kind of your outlook and your expectations looking out for 2020?
Sure. These limited service hotels we've owned, that we own now and have owned in the past, usually in November and December, and sometimes in January, there's seasonality where business travel is lower and group travel is lower. So we always have to allow for that. We had some seasonality in the 2 hotels in November and December. We expect revenue to pick up going into the fourth quarter and certainly into the second quarter. In both situations, there are group trips and other activities in the areas where our hotels are located, and we should see revenues pick up significantly, like I said, in the first and second quarter.
Got you. And then just real quickly, staying on the topic of hotels, notwithstanding the seasonality you're talking about, have you seen any kind of change or potential change in demand that could be attributable to the coronavirus yet, or is it still too early to tell?
We have not seen any change in demand as a result of that. We've checked with our hotel managers that are booking rooms really on an every other day basis, and we have not seen any problems with that yet.
Understood. On your lease expiration schedule, I believe you had some leases that were set to expire in 2020. How are, just from a high level, how are those conversations shaping out with tenants thus far? Are there any updates there that you could provide?
We've not contacted those tenants yet. We usually wait until 6 months prior to their expirations, and so that's our strategy. We use outside leasing agents to handle our leasing arrangements, but we usually wait until 6 months prior to a tenant maturing.
Understood. And then you started touching on the deployment, talking about maybe closing some more assets in the first half. Could you maybe talk about the types of assets that you guys are looking at? I know the market will always be the Southeast, but is there anything do you think you might do a foray into multifamily, or do you think you'll be sticking with these kind of retail strip centers? Just want to maybe get a flavor for what you guys are looking at in your pipeline.
Well, we love multifamily. It's a little expensive right now. We're developing a strategy on purchasing multifamily. The 2 properties we have on our radar. One is a flex property, 90,000 square feet, located in Chesapeake, Virginia, in a great area of Chesapeake where there's a lot of economic activity. Another property is a shopping center in Newport News, Virginia, on a heavily traveled road, Warwick Boulevard in Newport News. The main anchors there are AutoZone and Food Line.
And then just touching back, bringing that all back home to kind of the current events, which is on everyone's mind, I think, of the coronavirus. How are you viewing, the rush or patience towards deploying capital? And I'm asking that because obviously debt costs continue to get very favorable, so the opportunity to lock in some ultra cheap long-term debt is probably better than it's been in recent history right now, but there's also still some uncertainty. So are you guys maybe a little bit more cautious and trying to wait and see with how everything plays out, or do you think you're really going to be still just trying to lock in the properties that you're looking at right now and take advantage of the low-cost debt markets?
Yeah, well, thanks for asking that question. I mean, right now, the latest numbers we've seen are way sub 4% on most assets. I would say right now we could get 3.5 to 3 3/4 on shopping center, neighborhood shopping center, flex property, or hotels. Multifamily, I think, is around 3.10, all for 10 years fixed. Very, very cheap debt. We have not seen a lot of hand-wringing regarding the coronavirus in the Southeast. Activities are still going on. The Atlantic Coast Conference ACC tournament for basketball is still on for this week. We have a Furniture Mart, which is a huge event in the Greensboro area that will benefit our Hampton Inn. That is, no one has canceled there. So we haven't seen any real worry about the coronavirus in our area as of yet. So we're very fortunate in that regard, in my opinion, and we keep our fingers crossed, and we won't.
Great. Well, listen, I appreciate the clarity there. I look forward to reviewing the 10K filing when that comes out. And again, just want to say congratulations. I think the sequential jump in earnings is certainly, kind of showing the value of the properties you've been assembling.
Thank you, Ben.
As a reminder, just star one on your telephone keypad if you would like to ask a question. Our next question is from John Wheeler with Wheeler Real Estate Investments. Please proceed.
Good morning, guys. It's John Wheeler. How y'all doing this morning?
Very well.
Wanted to touch base. I had a couple questions that I'd like to ask online and offline as well. Could you repeat your telephone number, Tim?
Sure, 804-344-4435.
4435. All right, thank you. I appreciate it. I was looking at some of the financials on the SEC website, and again, I would agree with the previous caller. Congratulations on doubling the size of the portfolio from 3 to 6. My first question is, and again, it may be more of an offline question, but it looks like you're paying, based upon fourth quarter, the 8 cents, if you just annualize that times 4 quarters, assuming that was the number, you're paying out 50 cents a share annualized, and you only earned 8 cents in the fourth quarter. So my question is, when you do the math on that, you're paying out about 36% more than what you're earning. And I'd like to get your comment on that because it seems a pretty aggressive, for example, if you're earning 8 cents and you're paying out 12.5 cents, if you could address that first question.
Sure. The 2 hotels had seasonality issues in November and December. If they perform the way they normally do during the year, we've been very close to covering or over-covering our dividend.
So you think that you could bridge, if you use fourth quarter results as a benchmark metric, you could bridge that 36% on a quarterly basis? So Q1 over Q4 of last year?
Q1 and Q4 over Q1 last year has nothing to do with the financials today.
No. I'm talking about I'm talking about Q1 of 20 when you report, based on what your statement was. If you earned 8 cents a share,
we should be much closer to covering our dividend in Q1 than we were in Q4 because we expect the hotels to perform better. Q2, we expect them to perform better than Q1. So we are getting very close to either covering or over a couple of quarters.
Okay, that's good to hear. Tell me about, you're a diversified REIT, and the market traditionally, and I know you're on NASDAQ, the market traditionally discounts diversified REITs. And I heard this morning that not only are you in office or a warehouse, retail, and hotels, but you mentioned apartments. If you did that, that would be 4 different property types. Are you running financials individually on each product type internally and then have a consolidated statement with currently those 3 different product types combined?
That's correct. Look, this strategy is born out of Bill Elliott's experience in the commercial real estate space. Our strategy is to build a portfolio of workforce necessity real estate comprised of 4 property types. And those 4 property types are flex industrial, limited service hotels, multifamily, and neighborhood retail, not large shopping malls.
Okay.
We have managed and owned that type of property since we started as a private equity company in 2003.
Okay, thank you. So tell me about external management. When a company is externally managed as a real estate investment trust, publicly traded real estate investment trust, like the diversified REITs, they're discounted. When you're externally managed, my experience is the stock is discounted. And when I look at where the 52-week high of the stock was versus where it is today, it looks like you're down 72% if you look at 52 weeks ago versus today. So if you could address external management and stock
I'll
price
address
as well.
that offline. John, you could call me back on my number. We'll talk about that. Our fundamentals are very strong. If the street wants to discount us because we're diversified, that's their option. But you may call me back on that question.
Okay, good. I will. Okay, well, then I'll hold my comments there because I think I have some more hardline questions that'll need direct answers. And being a stockholder, I'm sure you'll be transparent with me.
Sure, absolutely.
Thank you all. I appreciate it.
With no more further questions in the queue, I would like to turn the conference back over to Mr. Messier for additional closing remarks.
Again, thanks everyone for getting on the call this morning. We are very happy with our earnings. We're very excited about the future. Again, we plan to add properties as we move along. We plan to grow. We have an extremely strong team of people working with us, and we're very happy where the company is now, and we thank you for being on this morning.
Ladies and gentlemen, that does conclude our conference for today. Thank you so much for your participation. Have a wonderful day. You may now disconnect.